You're listening to the Multifamily Mentor Show.
My name is Terrence Doyle.
And I'm Chris Lopez. You probably know us from the Bigger Pockets Real Estate Ride Along show. Well, now we're talking everything multifamily. We bring in top industry experts from around the country to come join us in our Denver studio for an in-depth, in-person conversation.
We're going to be diving deep into deals, underwriting, raising capital, and everything in between. Join the conversation.
What's up, Bigger Pockets? Welcome back to episode 2, our 2-part series. We're doing a deep dive in raising capital and doing some creative things. Terrence, set it up for us.
Episode 2 with the matchmaker, Esti Reizes-Lowenbein. I was going to mess it up, and I didn't want to butcher it. And so really excited to have you here for episode number 2. And one of the things we're going to dive into is your background in raising capital, specifically connecting co-GPs, JVs, and LPs with opportunity. And so one of the things we want to dive into, there's so many terms that people throw around, is let's define what a GP is, what a co-GP is, and what a KP is. Sounds like we're looking at a medical board there with all those 2-letter words, but let's dive into it. So GP, what is a GP?
GP, simple, general partner. And GP is the active partner in the deal. Okay. They have a say in the deal, they're in control.
GP, general partner, they're in control. I think that's the key, they are in control.
Yes.
Okay.
An LP, on the other hand, is a limited partner. They're more passive. They do not have control on the deal. They receive either pref equity return or a quarterly return or a yearly return, however it's structured based on the deal. If it's ground up, they'll receive returns once the property is cash flowing. Every deal is different, but they are the limited partner and they're more passive on the deal. They do not have control.
Yeah, so GP, full control. They are the operator. Their boots on the ground. LP, much more passive, no control, and very, very little say, right? It's passive. Okay, now talk about a KP.
KP is the key principal on the deal, where someone's going to come in and put the loan on their name. They're going to take responsibility for the property, whether it's a non-recourse or recourse loan. They have to have the liquidity and the equity in order to put the loan on their name. They often have to have a track record of investments for them to be the KP.
Right. So typically, as deals get larger and larger, and chime in here, as deals get larger and larger, institutions, bridge lenders, funds, REITs, people that are looking to place capital and be in the first position. So instead of, like when I started in Iowa and Denver, we were doing deals for $3 to $4 million. And so you'd have a local bank that would lend the money, and we were personally guaranteeing everything. As deals get larger, let's say 20, 30, 40, 50 million dollars, no one's looking to guarantee that, right? So now they have key principles that these funds are looking for that can show at least 10 to 15% of liquidity of the total loan, right? And they have a track record, and they're willing to sign for bad boy carve-outs, which basically means fraud. So if there is fraud, that person is guaranteeing a certain percentage of that loan. And so KP is just another way to get into a deal, because there's some operators that are doing deals, they know how to source deals, they know how to underwrite them, they know how to manage them, right? But they do not have the liquidity. So they'll bring in a more liquid, high net worth individual to sign on these loans when they're doing larger deals. Anything to add there?
Yeah, oftentimes KPs, also key principals, don't have the time to get involved in the deal, so they're signing on the deal. They're taking the liability, the responsibility for the deal. But they're obviously going to go in with people that they know and trust because it's their name on the line. But they often don't have the time to get involved. They're capable of doing it because they have the money and they're able to get the loan, but they often don't have the time and they're just looking to scale faster.
That's a great point, time. That people with this kind of liquidity and net worth often don't have the time. They have a bunch of other deals probably going on themselves or running their full-time business, and that is the way that they can leverage their assets and their net worth to get into deals without having to spend a lot of time. I love that. So now we want to talk about what are the ways to get into a GP. I mean, personally, so many people reach out all around the country and they're like, how can I be a GP in one of your deals? And they're obsessed with like just being a GP. They've been LPs or limited partners and passive in deals, and then several years down the road, they're like, okay, I want to be a GP now. So talk to us and explain to the audience, what are some ways that you have seen people and you yourself have been able to become in the GP, in the general partnership of a deal?
Yes. So you can either acquire the property and not as a broker, where you're acting as the acquisitions person. You're purchasing the property. You can bring the equity to the deal. You can bring the asset management, which is sweat equity technically, or you can be a key principal and sign on the deal. All those are general partners on deals.
That's right. So everyone out there listening, and you're starting and you have a bunch of energy, just like Esti. I mean, if you haven't heard her story, watch episode number 1. Incredible background of speech pathologist, master's in education, moves out of, downtown Brooklyn into the country and wants a change of life. And basically in the last 3 or 4 years has raised over $54 million in equity, done over $500 million in deals, all from just being an avid learner and a matchmaker of just always networking and meeting people. And so if you're out there and you're like that and you really can, you look at her and you're like, I can do that same thing. I have those same skill sets, that same kind of ambition, but I don't know how to source a deal. I don't know how to manage a deal. I don't understand construction, but I know people and I have a network. This is how to get into deals, right? Is you can source it. So you have a lot of relationships on the ground. You can find a deal. You can bring the equity. You can find someone that can be the key principal, or you can be the key principal on a deal, or you're going to be the asset manager. You're going to manage it. You understand construction and property management, and you could approach someone that has the deal but maybe doesn't understand construction and asset management as much. I mean, Chris, you work with a lot of investors around town. I mean, how many times are people coming to you saying, hey, how do I get into a deal? How do I become a general partner? How can I be, how can I leverage my skill set to get into a bigger deal?
It's an extremely common question, as you're talking about, but the thing is, a lot of times they don't have one of those key traits or skills to bring to the table. Like, hey, I want to be in here. Great, you want to be in here. What do you bring in the table? Because partnerships, there's pros and there's cons. And a lot of times partners are liabilities. That's right. So they got to be, what do you bring to the table is always what I ask them. I'm like, oh, well, I'm eager, I'm motivated. Great, that's wonderful, right attitude, but you have to bring more than that to get a piece of the pie.
That's right. You have to bring real value, right? You have to bring real value. If you want to be the GP in the GP, you have to be able to bring real value. There's probably a host of other ways. These are the top 4 ways that, we collectively have seen people be able to get into the general partnership. And why do people want to get in the general partnership? The general partnership was where all the fees flow up to, right? So acquisition fees, asset management fees, refinance fees, and then the promote at the end when you sell. And so that is why so many people are like, I want to get into the GP. I want to get into the GP because the economics are much better, right? If you invest as an LP, you're just going to get your pref plus the return, right? Which in the last 5 to 10 years has been phenomenal, right? But the GP gets those returns plus a little bit more because they're getting the fees and a disproportionate return on their capital and their time. And so being in the GP is sexy. A lot of people want to do it, but you have to bring real value. Bring real value.
And you have a say in the deal. You have an active participation, say on what's going on in the deal. You're an active member.
That's right.
You can vote on the deal as well as a GP.
That's right. Control is the key there, right? Control. And so the one thing the other part of this episode we want to talk about is, you are a matchmaker. So one of the things that you've talked about, your passion and what you say you do best is connecting GPs and sweat equity with capital, right?
Yeah.
That's one of the things that I think you just really light up talking about. And so we want to dive into that. And so walk us through the process, right? Someone calls you, sweat equity means they know how to find the deal, they know how to execute on the business plan, sweat equity, right? So when someone calls you and they have a great opportunity, what is the process for you to help connect them and be the matchmaker?
This is a self-made process that I've just done, and I'm still figuring it out as I go.
The book's coming out next year, though. She's going to have a book on it.
Yeah. I should, right? I should definitely do that.
Right.
I feel like I'm only getting started. So although I've done a lot in a short period of time, I feel like I'm only getting started. I don't consider myself a pro yet, but to share with you all, here's my method. So if a sponsor approaches me, generally they'll approach me once they're under contract already. Or sometimes they'll come to me before and I'll tell them, reach out to me when it's really happening. I don't want to hear about deals before. I have a lot going on. When something's substantial, reach out to me. Then I'll ask them, would you like to bring on general partners or would you want only limited partners? Are you willing to give up control on your deal or not? If they bring on co-GPs, then they're giving up control and there's someone else on the deal having a say on what's going on. So that's number one. That's what I'm going to do. You have all kinds of people. You have people that are going to say, no, I don't want anyone telling me what to do. I only want the money. And that way, I'll raise through my funds. I'll raise from limited partners through my funds, and that's where I get very, very picky about which deal I raise for. I'm going to vet the sponsor, check their track record, underwrite the deal, make sure that it's a legit deal, and then only then will I present it to my investors. Because that's where I have to make sure that it's, and another point is that every single deal that I raise from LPs, I put my own money in. So I have to really, really like the deal in order for me to bring on more investors. If I'm not bringing on limited partners, I'll bring on general partners, then it's easier on a different sense. You know, general partners are people that generally with more experience. They know the market, they know real estate. They're just coming in with, they like the deal that was presented to them, and they're coming in with their capital. They're bringing their capital into a deal, and oftentimes it's just much easier to connect several sponsors together. And when I'll present the deal to them, I'll present the teaser. If they like the deal, then they'll ask for more information. I'll send them all the information I have. Everything is transparent. They get the underwriting, they get the deal. If they like the deal, then they will. I will connect them to the sponsor once I have my agreement in place. I'll connect them, and the two of them sort of have to like each other, and they have to like the deal, and they kind of work out the splits between each other. Mm-hmm. They can renegotiate the splits. You know, if the capital partner is coming in with more, you know, he'll say, okay, I want a bigger percent of the deal, and they'll work it out between each other.
And you said this was often an easier way? Like, yes. Why? Dive in that if you could for us.
Sure. So I feel like people that are professionals in the real estate market, people that know the market well, they studied it, they know what the market's all about, what the cap rates are at. You know, they know the locations, they know the assets that they're going into, so they have more of an understanding of real estate versus a limited partner often has a W-2. They have a different job. They know nothing about real estate. And that's where I come in and have to explain everything to them and explain why it's a worthy investment and why they should put their passive money into the deal. And I tell them they can make money while they sleep, doing absolutely nothing, mailbox money. So there's benefits to doing that, but there's a lot more explaining to do when I'm raising from limited partners.
Walk me through, so I think this is amazing. I think this is a great way for people that are getting started to get into deals and to add real value, right? Is using their relationships and their network, because everybody has a skill set and a strength that they can use to be involved in multifamily. But one of the things I'm curious about is, you know, these deals move pretty quickly, right? When you find something off market or a real value add deal, you have to be able to move quickly. So how much time does it typically take for option one and option two? Option one being they're comfortable giving up some control, wanting to bring on another co-GP, and option two being LPs. I mean, how much time do you need in the process? Like if someone calls you and says, Esti, I have a deal and I have to close in 21 days. Is that enough time for you? Or what is the time where it's like, hey, if you give me this much time, I can get this done for you?
Oh, that's such a great question. Co-GP is so much easier. Limited partners, I'm waiting for my attorney to draft the SPV that I'm adding to the fund because I have a Delaware Series LLC where I can have several SPVs within one fund. Mm-hmm. So I'm dependent on my attorney, who it became super popular and is so busy these days. He's great for that reason. And I have to set it up through the portal, which is also time consuming. So it's definitely harder and more time consuming to raise from limited partners. Mm-hmm. Also, you want to make sure you're doing everything 100% right. Then you have to go ahead and...
Because you have to create your own OM, right? You have to create your own offering to show it to your LPs to then call the capital?
I'm not really creating my own PPM, okay. More like it's a private placement memorandum. I'm kind of piggybacking off the deal.
Got it.
I just have a general agreement that my fund has, and then every deal has its own waterfall. Waterfall is a return to the investors.
You just have to scrub the deal, right? Because you're showing it to a list of investors that you already know and has already committed capital.
Right.
So you just scrub it, and then you are basically signing off saying this is a deal that we'll do, and then you're putting out there, and then you're calling the capital.
So I'm doing a deal-specific raise. So first I have the deal, and then I go out and raise.
Then you go out and raise it.
Yeah, maybe eventually I'll do a
blind. What does that time frame look like?
So that's the tricky part. It is tricky.
That's not fast.
Right, it's not. It's difficult.
You're right.
So between my attorney and setting up the portal, and then getting the investors and having to verify that they're accredited,
right.
And then only then does the money come in. it's time consuming. It is true.
So what do you think? 4 weeks, 5 weeks? I mean, what's an average that people could say, okay, that makes sense. I understand that if I'm going to give someone like Esti a chance to come into my deal, I need to leave this much time.
Yeah, so right now my attorney has been so busy, so I've been like waiting for that. But I think that as my list of investors grow, it's going to get shorter and shorter because I'm going to be able to just send out an email and say, hey, we have this opportunity. Who wants to come in? I think it's going to get shorter and shorter as time goes on.
Okay, so then connecting, so that process takes a little bit longer. Connecting GPs, right? So you have one sponsor that has a great deal, you have another sponsor that maybe has some capital, and they have a really good marriage. What is that process? What's the time frame there look like? That
could be a day, technically. It depends on how fast I get the teaser from or I'll write a teaser myself. I'll have a call with the lead sponsor. I'll send out a teaser. Do I have interest right away? I'll send them a deal right away if they underwrite it fast. They're ready to go. They're ready to have a conversation. I've connected people. Well, the first deal I've done, within 2 phone calls, I got one sponsor, and within a few days, the money was wired.
Wow. That's phenomenal. Okay, so how does someone like yourself get paid in both of those scenarios? Scenario 1 being the co-GP, connecting GPs, and then LPs. How are you, the matchmaker, getting compensated?
So very careful. You're not allowed to not allowed to take a percentage based on how much you raise. So I always charge a set fee. That's what I do from these sponsors. So
that's a pro tip right there. Is in episode 1 we talked about the SEC and how they're coming down on these kind of structures, and your compensation cannot be directly tied to the amount of money you raise. It can't be, hey, I'm gonna get 10% of every dollar or 1% or any percentage. It has to be a flat fee.
Right.
And the flat fee can be based on the work you're doing and the value you're creating, but it has to be a flat fee, right? So you can definitely charge a higher fee if you're raising 1 million versus 100,000, right? Or vice versa. So it has to be a flat fee. You can never, ever, no matter what anybody tells you, charge a percentage of what you raise. Definitely consult with an attorney, but that is just basic fundamental SEC law in this game.
Even as a co-GP, you cannot only get paid based on how much you raise. You still have to have other roles.
That's right.
As a co-GP on the deal.
That's a great point. So what are some of the other roles that you've been able to do?
Investor relations, I verify investors, underwrite the deal.
Marketing. There's a bunch of other ways so to be in the GP, not just be your compensation tied to raising capital. So be very careful about that. Consult an attorney, but that's just low-hanging fruit, like fundamental 101. You cannot have your comp directly tied to a percentage of how much you raise. Flat fee. Okay, so you are charging the GPs a flat fee, and talk about the timing of that, because one of the things I liked is that you meet a sponsor, they have a deal, they need capital, and you have them sign a fee agreement right away before you spend any time or put it out to anybody.
Well, first I'll have a conversation with them. I take notes on what they're saying. I want to hear about the deal. That's when I'll kind of come up with my compensation.
Right.
And how I see going forward, based if they're going to want LPs, if they're going to want GPs. I need to get an idea how fast they need the money, when do they need to close, and then I'll come up with the fee. Yeah.
Right.
Not always do the deals work out, even though we had a fee set up. I don't have investors for every single opportunity.
That's right.
I always say I have a buffet of opportunities, and I never know who's going to want what. So I always let the sponsors know that I'm going to do my best, and I'm going to try.
Yeah.
As my list of investors are growing, it's becoming easier to connect people. But just within commercial real estate, there's so many assets, and I'm raising for parking lots and RV space, mobile home parks, existing multifamily, ground up developments, you name it. There's in every single asset, hospitality. I have surgical centers that I'm raising for right now. So you don't know who's going to bite at what. Mm-hmm. So I always let them know that I'm going to do my best to find them an investor. But if I do, this is what I'm going to be charging. And then I go out there and reach out to investors. And if I have somebody that's interested, I'll set up a call. We'll have a conference call, that's my latest thing. I have conference calls all day long. I was riding the gondola the other day, and I'm on a conference call. I just set it up, and the parties communicate, and I have everything in writing. So that's how I do it.
Love it.
And this I'm going to highlight from our first episode, or we talked before, but about your superpower, which is great at connecting people. And we're talking about before how people ask you, why don't you niche down to like one asset class? And you just rattled off a dozen different asset classes, in the real estate space. Yeah. But again, your specialty is connecting people and connecting deals, so you don't have to be specialized into one deal. Right. If you have all these deals over here, all these people over here, you do the buffet matchmaking like you said. Right. So that's a really important thing for our viewers to take away on that. Focus on your skill, double down on it, and do what she does or do what you do, and you can make it work for your situation.
Right, but not everyone's like me.
Yes.
I am a little different than most people. I probably work a lot harder than most people. I have that hustle bug in me, and I'm willing to put that effort and energy in. Some people do need to find that niche and that specific asset. I think everyone has to evaluate what works for them. Just because I'm a little crazy doesn't mean that I'll go for everybody. Some people do need to narrow it down to one thing, but I always say that I raise from LPs, JVs, co-GPs, and GPs. I'll find deals as a broker for GPs. So I help anyone invest in real estate on all levels, from 50,000 and up.
That's huge. So talk a little bit about, because people look at what you're doing or what we're doing and they're like, oh my gosh, this is amazing. It looks so easy. It looks so fun. It looks so glamorous. You and I were talking about just resilience.
Oh, yeah.
Right? I think the number one trait that someone needs to have if they're going to raise money is resilience, right? Because you're going to hear no a lot. And when the market turns, you're going to hear a lot of people that are scared, that are afraid, that have a lot of questions, that have concerns, or that maybe don't like something. When you deal with people's money, you're going to get a different side of them than you've probably ever seen before. So talk a little bit about your experience dealing with people like that and just the resilience factor of all the things that go bad and all the time you put into deals. And I think you said close to 90% don't even work out.
Exactly. Well, this applies to being a realtor, an investor, and a capital connector. There are so many things that just don't work out. Right. There's so many times that you put in hours and hours and hours and people are like, wow, this job is so glamorous. I'd love to do what you're doing. They don't see that I put in 100 hours literally into some deals and then they fell through last minute. The buyer didn't come through, the capital didn't come through. It seems glamorous on the outside, but I always say I should start posting more of the difficult parts and letting people see the reality of what's really going on, because it's not all unicorns and rainbows and unicorns or whatever the saying goes. I developed thick skin in this business. I say that I matured greatly over the last 4 years. Right. I don't think I could have done this business 5 years ago. I definitely, mustered up and got stronger doing this. I also look at it now as deals that don't go through me weren't meant to be mine. I had to shift my mindset and realize there's things that are meant for me and things that are not meant for me. Right. Whatever didn't happen wasn't meant to be mine. It wasn't meant to go through me. I wasn't meant to make that commission. Mm-hmm. And that's the only way you can go about it. Like Hal Elrod says, if a deal goes bad or if a situation doesn't go your way, you're allowed to get upset. You can get upset for 5 minutes. Once that 5 minutes is up, you have to get up, brush yourself off, and pick yourself up and move on, because there's no moping about things. You cannot. Totally. You have to keep on and go on to the next opportunity.
Yeah. That reminds me of one of my mentors early on when I first got into sales, non-real estate related, gave me that advice. And he also said, you know what the best solution to that is?
Yeah.
Have more deals or have more prospects in the pipeline. You have a full pipeline, you get to know, or 100 hours goes to a zero compensation.
Yeah.
Hey, it stinks for 10 minutes, but if you get 10 more deals in the pipeline, that helps you get over a lot quicker.
Exactly.
Versus, there's nothing in the pipeline. Then you sit there and dwell on it.
Yeah.
So stay busy like you are. And I want to ask about that too, because you mentioned a few times, you're hustling here, you have 8 kids. What does your typical work week look like? Not from a schedule standpoint, but from just your mental energy and time commitment to make all this work.
So number one, my kids come first. That's number one, no matter what. I've had to cancel meetups and things that I was so excited to attend, gatherings I had to cancel because my kids will always come first. They're my priority. Besides around them, they're all in school. So generally I can work a lot when they're in school, and then when they go to sleep, I'm working a lot. This is hard work. This takes a lot of hours. It's not a 9 to 5. It's literally around the clock. So I also stopped hosting more. I started hosting less on the weekends because that's when I give my kids 100%. Mm-hmm. That's the only way I can do it, because I do work a ton through the week. sometimes throughout the nights, I'll work. It takes a lot of energy if anyone's getting in, and you got to be ready for that. You know, the commission at the end of the day is nice, but it takes a lot of time and energy.
I think it's good to emphasize because you talked about how people think it's very glamorous, and it can be, but you know, when you're at the top of the mountain, they don't realize the 10 miles you hiked up, or whatever analogy you want to use. Like, it's tough work to get there.
Yeah, I was telling Terrence before, we went into contract and we were supposed to close on a property in March. We still haven't closed on it. We're hoping to close this month, but it just drags on. And in the meantime, we put money into due diligence, and we have hard money sitting there. You know, things don't always go as planned, or we went hard on a certain deal and lost $250,000 because the numbers weren't right, but we went hard on it. There's always wins and losses, and you got to eat them, and and enjoy the wins, and move on. Got to move on. That's the whole name of the game.
I love your, tip on just keeping your pipeline full, because I definitely agree. Like, we were talking about it. You spend all this time and energy on a deal. Your team has a bunch of hours in it. Your company has a bunch of money and due diligence and earnest money, and then deals fall apart. Financing changes, the seller changes their terms, or maybe they're really stubborn on certain inspection items. And so you have to have resilience, and you have to have a pipeline so you can move on. And it just gives you perspective, right? When you lose a deal and that's the only deal you're working on, that's soul crushing. When you lose a deal and you have 10 more behind it, you can move on a lot quicker. So I do like that tip. I think the key to the whole thing is just resilience. It is so hard. I mean, if we're just talking about capital, the whole thing is hard, but raising capital is so difficult. I think it's one of the more difficult parts, even though everybody has money right now and there's a ton of liquidity in the system. Raising money for specific opportunities is super, super difficult. People are selling courses and books and, speaking engagements and charging bunches and bunches of money to be able to teach this one topic because it's so hard.
I think those people are making money on all those classes and books.
Right. And everyone else is trying to figure it out how. So I think, Esti's definitely onto something there, with resilience. Talk a little bit about, we're winding down here. Talk about the idea of how raising larger chunks of money is actually easier than raising $50,000 or $100,000.
Yeah, so like I said before, these people that are coming in with those larger amounts of money generally have a great understanding of the market. They know real estate, they know the asset class that they're looking into. They generally know the market that they're going into, or they're ready to learn and they're quick learners. Their understanding of real estate in general and what it offers and the tax benefits of appreciation, depreciation, they know that they can go visit the property. There's more of, it's easier to talk to them because they have a better understanding versus a limited partner is someone that has a different job or someone that just doesn't want to bother with termites, tenants, and toilets, and they just want the three T's, and they just want their money working for them, which is also nice.
Right.
But generally, the LP side, the limited partnership side, they don't have that the solid understanding of the business. So it's like it takes more effort to get through to those investors.
Absolutely. One of the things, another pro tip here when you're raising capital is you want to figure out how to get to a no as quickly as possible. The worst thing you can do is spin your wheels talking to people over weeks or months or years that are like twiddling their thumbs, kicking the tires, and don't really know what they're looking for, what they want, and what a deal is, or have identified their goals or any of the above. Typically, when you're dealing on larger deals, the debt's a lot easier. Like, let's talk about, when you're dealing with deals 20 million and up, you're talking about raising chunks of capital in $500,000 or $1 million chunks, right? And so when you're dealing with people that have that kind of money, you're typically talking to very sophisticated investors or funds or family offices. Those people invest money for a living. When you're talking to people that invest money for a living, they can give you a no very quickly. And those are the kind of people you want to be talking to, right? You don't want to talk to, the teacher in Long Island that, has a 401k and she's looking at 15 different asset classes in 14 different states. She's going to not ever be able to give you a clear answer. And she's the kind of person that the day before closing will call you and say, I changed my mind. But if you're talking to the fund manager in New York that has 50 million under management and he gets paid to deploy capital, that person is going to with certainty tell you yes or no in a short amount of time. And so I think one of the best things that we try and do is just talk to people that know what they're doing and invest money for a living. If people are investing money for a living and they're sophisticated, they're going to be able to get to a no much quicker.
Definitely.
And that's really what you want. You want to get all the no's out of the way so you can find people that are going to say yes. And so, one of the ironic things about doing real estate and raising capital is that what I've found is the larger the deals you're doing, as long as they're good deals and they make sense, it's actually a lot easier to get the equity and the debt, and at better terms. And you're going to be dealing with much more sophisticated people, which will make your life easier when there's turbulence, downturns in the economy, interest rates are going up, and there's just a lot of uncertainty as we're seeing right now. And so I think some of those tips are going to be really key for those of you out there that are looking to make this kind of your way into the multifamily space.
Well, one big tip that I've learned that I don't even know if we discuss or if anyone discusses is always to have a backup investor for a deal, no matter what.
Love that.
Even if a deal is looking great.
Right.
I've had some deals that like the investor backed out last minute, or the investor came in last minute. So just last week I closed on a deal. The investor literally came in at the closing.
Wow.
So it's so important to have backups.
So do you, let's say I have Terrence as my investor, and then he backs out. If I'm following your advice, my prep, do I already have you in queue and say, hey, you're my backup investor for this deal? Or do you tell that to the person? Or is that just, hey, have investors there?
Yes.
So hey, if he falls out, I can make a few phone calls and raise the money.
Exactly, yeah. You have to have people in mind. Obviously, you're not going to tell them that you're the backup. That doesn't feel good. But you're gonna have people on in your back pocket just ready to go. And let's say someone you didn't even present the opportunity to, but you know that that's their asset. I'll have a list of people that I can go to, and last minute. You never know. Even broker dealers, I know they can't. I know a few people that had to borrow money at the closing table. They had to take out a loan because the broker dealer couldn't come up with the capital.
Really?
Yes. Yes, I've several situations recently where the broker dealer promised to bring in a certain limited partner, and that person didn't come through. So they took out a loan, and now we're backfilling that money.
So one of the key things that I love you're touching on this is having backups is one of the ways to do it is just over raise for the deal, right? So let's say you really only need 5 million. Maybe you go out to the market and say you're raising 5.3, and that way if you don't fill the full 5.3, you still have some backups. Or if you fill the full 5.3, you have $300,000 or $500,000 in margin to where people could still back out and you're good. And that way you're not calling anyone, your backup.
Right.
Capital,
Many times also at the closing table, they're scrambling for an extra 100,000, 200,000 that they didn't foresee. Closing costs sometimes cost a little more. We had that with my deal. We had to come up with an extra, so thank God we had extra reserves where we were able to deploy that 100,000, 200,000 quickly without having to reach back out to the investors because the closing costs did cost more than expected.
Yeah, the other thing, those larger deals, the attorney's fees do get out of control, and sometimes closing costs with the loan. And so I do think over equitizing a deal is very, very smart, especially on larger deals, because you never know, who is going to back out and what's going to change. Any closing thoughts for the audience, Esti?
Network away, hustle away, try your best.
That's right. There you heard it right there.
Network and hustle.
Network and hustle. From the matchmaking queen right here.
Serial
we have
networker.
Yona Weiss, the cost seg king, and here we have Esti.
Yona Weiss is number one.
He is the best. Shout out Yona Weiss. And Chris, you want to take us home?
Yeah, so we forgot to say earlier, make sure you like the video, subscribe to the channel, and leave us comments. We'd like the feedback. We appreciate you guys watching this. We'll see you next week.
You're listening to the Multifamily Mentor Show.
Join the conversation.